Question 1. According to SEC Rule 15C3-1, a broker-dealer's net capital must be at least what percentage of aggregate indebtedness? A. 2%. B. 6 2/3%. C. 8%. D. 10%. Answer: B. 6 2/3%. The basic net capital requirement for a broker-dealer is that its net capital must be at least 6 2/3% of its aggregate indebtedness, or a minimum dollar amount, whichever is greater. This rule, known as the Net Capital Rule, SEC Rule 15C3-1, is crucial for ensuring a broker-dealer's financial stability and its ability to meet its obligations to customers and creditors. For example, if a broker-dealer has $1,500,000 in aggregate indebtedness, its net capital must be at least $100,000, 6 2/3% of $1,500,000. Always remember that the 6 2/3% ratio helps ensure that a firm maintains sufficient liquid assets to cover its liabilities. Question 2. Under SEC Rule 17A-4, most required books and records must be preserved for how many years? A. 2 years. B. 3 years. C. 5 years. D. 6 years. Answer: D. 6 years. SEC Rule 17A-4 mandates specific retention periods for broker-dealer records, with most essential books and records, such as ledgers, blotters, and account records, required to be preserved for a period of 6 years. This rule ensures that a firm maintains a comprehensive audit trail of its financial transactions and customer interactions, allowing regulators to examine the firm's compliance with securities laws. For instance, a customer account statement from 2020 would generally need to be maintained until at least 2026. Understanding these record retention requirements is fundamental for a firm's operational compliance. Question 3. A broker-dealer must notify the SEC and FINRA of a net capital deficiency if its net capital falls below what percentage of its minimum requirement? A. 100%. B. 120%. C. 125%. D. 150%. Answer: B. 120%. A broker-dealer is required to provide early warning notification to the SEC and FINRA if its net capital falls below 120% of its minimum net capital requirement. This notification system is critical for allowing regulators to intervene proactively if a firm's financial health is deteriorating, ensuring that potential issues are addressed before they become severe. For example, if a firm's minimum net capital is $250,000, an early warning would be triggered if its net capital drops below $300,000. Recognizing these trigger points is key to maintaining regulatory compliance and avoiding more serious violations. Question 4. Which of the following describes a key purpose of the Customer Protection Rule, SEC Rule 15C3-3? A. To establish minimum net capital requirements for broker-dealers. B. To ensure the prompt delivery of securities to customers. C. To safeguard customer funds and securities from misuse or insolvency of the broker-dealer. D. To dictate the types of securities a broker-dealer can trade. Answer: C. To safeguard customer funds and securities from misuse or insolvency of the broker-dealer. The Customer Protection Rule, SEC Rule 15C3-3, is designed primarily to safeguard customer funds and securities. This is achieved by requiring broker-dealers to segregate customer securities from firm assets and to make weekly computations of a reserve formula to determine the amount of cash or qualified securities that must be on deposit in a special reserve bank account for the exclusive benefit of customers. For instance, fully paid customer securities must be kept separate and distinct, preventing them from being used for the firm's own business purposes. This rule is essential for protecting investors in the event of a broker-dealer's financial distress. Question 5. When must a broker-dealer generally file its annual audited financial statements with the SEC and FINRA? A. Within 30 calendar days after the end of the fiscal year. B. Within 45 calendar days after the end of the fiscal year. C. Within 60 calendar days after the end of the fiscal year. D. Within 90 calendar days after the end of the fiscal year. Answer: C. Within 60 calendar days after the end of the fiscal year. Broker-dealers are generally required to file their annual audited financial statements, specifically the Focus Report Part IIA, with the SEC and FINRA within 60 calendar days after the end of their fiscal year. This filing is a crucial part of a firm's ongoing financial reporting obligations, providing regulators with a comprehensive review of the firm's financial condition, conducted by an independent public accountant. For example, a firm with a December 31st fiscal year-end would typically need to file its audited statements by the end of February. Adhering to these strict deadlines is vital for regulatory compliance. Question 6. Under SEC Rule 15c3-3, a broker-dealer must calculate the amount of cash or qualified securities required in its special reserve bank account for the exclusive benefit of customers. A. Annually. B. Quarterly. C. Monthly. D. Weekly. Answer: D. Weekly. SEC Rule 15c3-3, the Customer Protection Rule, generally requires a broker-dealer to make a weekly computation of the reserve formula to determine the amount of cash or qualified securities that must be held in a special reserve bank account for the exclusive benefit of customers. This frequent calculation ensures that customer credits are adequately covered by segregated assets, providing a dynamic safeguard against the firm's potential insolvency. For instance, if debits exceed credits on the reserve formula computation, the firm must deposit the deficit amount into the reserve account. This weekly requirement highlights the importance of real-time customer asset protection. Question 7. Which of the following would generally be considered a non-allowable asset for net capital computation purposes? A. Cash in bank. B. Receivables from a clearing broker. C. Prepaid expenses. D. Marketable securities owned by the firm. Answer: C. Prepaid expenses. Prepaid expenses are generally considered non-allowable assets for net capital computation purposes because they cannot be readily converted to cash to satisfy liabilities. The net capital rule, SEC Rule 15c3-1, focuses on liquid assets that can quickly be used to meet obligations. For example, prepaid rent or insurance, while assets on a balance sheet, do not contribute to a firm's regulatory net capital. Understanding which assets are allowable versus non-allowable is fundamental to accurately calculating a broker-dealer's net capital. Question 8. A broker-dealer's anti-money laundering (AML) compliance program must be approved in writing by A. The firm's chief financial officer. B. A qualified outside counsel. C. The firm's chief compliance officer. D. A member of the firm's senior management. Answer: D. A member of the firm's senior management. FINRA Rule 3310, which governs anti-money laundering (AML) compliance programs, requires that the firm's AML program be approved in writing by a member of the firm's senior management. This ensures that the firm's leadership takes ultimate responsibility for the program's effectiveness in detecting and preventing money laundering activities. For example, a firm's CEO or managing partner would typically provide this approval. This specific requirement underscores the importance of a strong tone at the top regarding a firm's commitment to AML compliance. Question 9. Under SEC Rule 1783, customer account statements must be maintained for how long? A. 2 years. B. 3 years. C. 5 years. D. 6 years. Answer: D. 6 years. Customer account statements, which provide a record of transactions and holdings for a client, are considered a core record under SEC Rule 17a-3 and must generally be preserved for a period of 6 years. This retention period allows for sufficient time for regulatory review, customer inquiries, and potential legal proceedings related to account activity. For instance, a statement issued in July 2020 must be accessible until at least July 2026. Firms must implement robust record-keeping systems to ensure these critical documents are retained for the required duration. Question 10. If a broker-dealer is experiencing financial difficulties and its net capital falls below its minimum requirement, what is the immediate action required? A. File a new focus report immediately. B. Notify FINRA and the SEC immediately. C. Close out all open customer positions. D. Increase its margin calls to all customers. Answer: B. Notify FINRA and the SEC immediately. If a broker-dealer's net capital falls below its minimum requirement, the firm is required to provide immediate notification to both FINRA and the SEC. This critical, immediate notification, also known as a Rule 17a-11 notification, is triggered by severe financial deficiencies and allows regulators to quickly assess the firm's situation and take appropriate action to protect investors. For example, if a firm's minimum is $250,000 and its net capital drops to $200,000, this immediate notification is mandatory. Prompt reporting of such deficiencies is paramount for regulatory oversight and investor protection. Question 11. Which of the following best describes the primary function of the focus report, Form X-17A-5? A. To report customer complaints. B. To document suspicious activity. C. To provide financial and operational information to regulators. D. To disclose insider trading. Answer: C. To provide financial and operational information to regulators. The focus report, Financial and Operational Combined Uniform Single Report, designated as Form X-17A-5, is the primary financial and operational report that broker-dealers must file periodically with the SEC and FINRA. Its main function is to provide regulators with a detailed snapshot of a firm's financial condition, including its net capital, aggregate indebtedness, and other key financial metrics. For example, it includes the balance sheet and income statement, allowing regulators to monitor the firm's solvency and compliance with financial responsibility rules. This report is fundamental to the oversight of broker-dealers. Question 12. A fully disclosed carrying agreement obligates the introducing broker-dealer to A. Maintain all customer accounts and execute trades. B. Maintain net capital requirements based on all customer accounts. C. Handle all back-office functions and record-keeping for customer accounts. D. Primarily introduce customer accounts to a clearing broker, with the clearing broker handling most back-office functions. Answer: D. Primarily introduce customer accounts to a clearing broker, with the clearing broker handling most back-office functions. In a fully disclosed carrying agreement, the introducing broker-dealer primarily introduces customer accounts to a clearing broker, who then handles most of the back-office functions, including the custody of customer funds and securities, trade executions, and detailed record-keeping. This arrangement allows the introducing firm to focus on client relationships and sales, while the clearing firm takes on the operational and financial responsibility for the accounts. For instance, the customer's statements would typically come directly from the clearing broker. This clear division of responsibilities is a common structure in the securities industry. Question 13. Which of the following is responsible for maintaining the record of all customer orders in a chronological sequence? A. Customer account ledger. B. Blotter. C. General ledger. D. Securities position record. Answer: B. Blotter. A blotter is a record of original entry that chronicles all transactions in chronological order, capturing essential details like the time of execution, quantity, price, and other relevant information for securities transactions. This record is crucial for maintaining an accurate audit trail of all activity, whether it involves customer orders, firm trades, or cash receipts and disbursements. For example, every buy or sell order placed by a customer would be immediately recorded on the blotter. The blotter serves as the foundational document for subsequent ledger entries and financial reports. Question 14. Under SEC Rule 15C3-3, excess margin securities are defined as those customer securities having a market value in excess of what percentage of the customer's debit balance? A. 100%. B. 120%. C. 140%. D. 150%. Answer: C. 140%. Under SEC Rule 15C3-3, excess margin securities are defined as customer securities held in a margin account with a market value that exceeds 140% of the customer's total debit balance. These excess securities must be physically segregated or appropriately placed in a good control location, away from the broker-dealer's firm assets. For example, if a customer has a $10,000 debit balance, any securities collateralizing that loan with a market value above $14,000, 140% of $10,000, would be considered excess margin securities. This segregation protects the customer's assets, even those used as collateral, from the firm's general liabilities. Question 15. Which of the following records must be maintained for the life of the broker-dealer? A. Customer account statements. B. General ledgers. C. Stock records. D. Articles of incorporation or partnership agreements. Answer: D. Articles of incorporation or partnership agreements. Permanent records, such as the Articles of Incorporation, partnership agreements, minute books of directors' meetings, and stock certificate books, must be maintained for the life of the broker-dealer. These documents establish the legal structure and governance of the firm and are essential foundational records. For example, the Articles of Incorporation document the legal formation of a corporation and its fundamental rules. These records are distinct from transactional records that have finite retention periods and must be kept accessible for as long as the firm exists. Question 16. A broker-dealer's chief financial officer, CFO, is primarily responsible for A. Directing sales and marketing efforts. B. Overseeing the firm's financial operations, including net capital and financial reporting. C. Supervising trading desks and market-making activities. D. Managing human resources and administrative functions. Answer: B. Overseeing the firm's financial operations, including net capital and financial reporting. The Chief Financial Officer, CFO, of a broker-dealer is typically the principal financial officer, responsible for overseeing all aspects of the firm's financial operations. This includes ensuring compliance with net capital requirements, preparing and filing financial reports like the Focus Report, and managing the firm's overall financial health. For example, the CFO signs off on the firm's audited financial statements, attesting to their accuracy. This role is crucial for maintaining the firm's regulatory compliance and financial stability. Question 17. If a broker-dealer acts as an introducing broker in an omnibus account arrangement, how are customer securities typically held? A. In the name of each individual customer by the introducing broker. B. In the name of the introducing broker by the clearing broker. C. In the name of the clearing broker by the introducing broker. D. In the name of each individual customer by the clearing broker. Answer: B. In the name of the introducing broker by the clearing broker. In an omnibus account arrangement, the clearing broker holds the securities for all of the introducing broker's customers in one omnibus account, typically in the name of the introducing broker. This means the clearing broker does not know the identities of the individual underlying customers. For example, the clearing firm's records would show an account belonging to ABC Securities, not individual clients John Smith or Jane Doe. The introducing broker maintains the detailed records for each individual customer. Question 18. Which of the following is not typically part of a broker-dealer's business continuity plan, BCP, under FINRA Rule 3130? A. Data backup and recovery. B. Alternate communications with customers and regulators. C. Designation of a single emergency contact person. D. Alternate physical locations for operations. Answer: C. Designation of a single emergency contact person. FINRA Rule 3130, regarding business continuity plans, BCP, requires broker-dealers to designate 2 emergency contact persons, not just one, who are qualified principals and available to provide critical information during significant business disruptions. A robust BCP typically includes strategies for data backup and recovery, alternate communication methods with customers and regulators, and alternative physical locations for operations to ensure continuity of business. For example, the plan must outline how a firm would continue to process transactions and safeguard customer assets if its primary office became inaccessible. The requirement for 2 contacts ensures redundancy and reliability in crisis communication. Question 19. For an introducing broker-dealer that clears its transactions on a fully disclosed basis, what is its minimum net capital requirement generally based on? A. The total value of all customer securities held. B. The aggregate indebtedness of its clearing broker. C. Its specific type of business and whether it carries customer accounts. D. A percentage of its total assets. Answer: C. Its specific type of business and whether it carries customer accounts. The minimum net capital requirement for an introducing broker-dealer that clears its transactions on a fully disclosed basis is typically a fixed dollar amount determined by its specific type of business and whether it carries customer accounts. Since such a firm generally does not carry customer accounts or handle customer funds directly, its net capital requirement is typically lower than a firm that acts as a carrying broker. For example, a non-carrying introducing broker often has a minimum net capital requirement of $50,000, as opposed to the $250,000 or $1 million for carrying firms. This reflects the reduced risk exposure when customer assets are held by a separate clearing firm. Question 20. When must a broker-dealer's Chief Compliance Officer, CCO, certify the firm's annual compliance report? A. Within 30 days of the firm's fiscal year end. B. Annually, prior to the filing of the firm's audited financial statements. C. Within 60 days of the firm's fiscal year end. D. Annually, concurrent with the delivery of the firm's annual audited financial statements. Answer: D. Annually, concurrent with the delivery of the firm's annual audited financial statements. A broker-dealer's Chief Compliance Officer, CCO, is required by FINRA Rule 3130 to certify the firm's annual compliance report, which addresses the firm's processes for establishing, maintaining, and reviewing its supervisory controls. This certification must be provided annually, concurrent with the delivery of the firm's annual audited financial statements, Form X-17A-5, Focus Report. For example, if the audited statements are due by February 28, the CCO's certification must also be filed around that time. This synchronized filing ensures that regulatory bodies receive a comprehensive view of both the firm's financial health and its supervisory controls at the same time. Question 21. Which of the following is typically excluded from a broker-dealer's aggregate indebtedness for net capital purposes? A. Accounts payable. B. Short-term bank loans. C. Deferred income tax liabilities. D. Liabilities adequately collateralized by securities being carried for the account of a customer. Answer: D. Liabilities adequately collateralized by securities being carried for the account of a customer. Liabilities adequately collateralized by securities being carried for the account of a customer are generally excluded from aggregate indebtedness for net capital purposes. This exclusion is permitted because these liabilities are backed by specific customer assets, reducing the firm's immediate unsecured financial exposure. For example, customer credit balances secured by customer collateral would not contribute to the aggregate indebtedness calculation. Understanding these exclusions is vital for correctly calculating a firm's net capital and determining its compliance with regulatory requirements. Question 22. Under SEC Rule 17a-4, electronic storage of records is permissible if the system meets certain requirements, including: A. Records must be convertible to paper format only upon specific request by the SEC. B. Records must be stored on non-rewritable, non-erasable, worm, media. C. Records must be retrievable within 24 hours of a regulator's request. D. Records must be stored off-site only. Answer: B. Records must be stored on non-rewritable, non-erasable, worm, media. SEC Rule 17a-4 specifies that electronic storage systems used for broker-dealer records must ensure the integrity and accessibility of the data. A key requirement is that the records must be stored on non-rewritable, non-erasable, worm, media, or a system that prevents alteration and destruction of the records. This ensures the authenticity and reliability of the stored information, akin to maintaining paper records in a permanent, unaltered state. For instance, an electronic record of a trade confirmation must be immune to post-creation changes. This strict standard is designed to prevent tampering and maintain the integrity of a firm's books and records for audit purposes. Question 23. What is the primary purpose of a haircut in net capital computation? A. To adjust the value of fixed assets. B. To reduce the market value of proprietary securities to reflect potential market risk. C. To increase the value of customer receivables. D. To account for goodwill and intangible assets. Answer: B. To reduce the market value of proprietary securities to reflect potential market risk. A haircut in net capital computation is a specified percentage reduction applied to the market value of a broker-dealer's proprietary securities positions. This reduction is designed to account for potential market risk and volatility, ensuring that the firm maintains a sufficient capital cushion against adverse price movements. For example, a common stock position might receive a 15% haircut, meaning only 85% of its market value counts towards net capital. This conservative valuation helps protect the firm and its customers from sudden losses in the firm's investment portfolio. Question 24. A broker-dealer must file a suspicious activity report, SAR, with FINRA within how many days of becoming aware of suspicious activity? A. 5 business days. B. 10 calendar days. C. 30 calendar days. D. 60 calendar days. Answer: C. 30 calendar days. Under the Bank Secrecy Act, BSA, and its implementing regulations, broker-dealers are required to file a Suspicious Activity Report, SAR, with the Financial Crimes Enforcement Network, FINRA, within 30 calendar days of becoming aware of suspicious activity. This obligation is a critical component of a firm's anti-money laundering, AML, program, designed to report transactions that may involve money laundering, terrorist financing, or other illicit activities. For instance, a series of unusual wire transfers or structuring of deposits would necessitate a SAR filing. Timely reporting of suspicious activity is essential for combating financial crime. Question 25. Which of the following best describes the role of the Designated Examining Authority, DEA, for a broker-dealer? A. The primary regulator responsible for setting net capital rules. B. The self-regulatory organization, SRO, assigned responsibility for examining the broker-dealer for compliance with financial and operational requirements. C. A government agency that investigates securities fraud. D. An independent auditor hired by the broker-dealer to conduct annual audits. Answer: B. The self-regulatory organization, SRO, assigned responsibility for examining the broker-dealer for compliance with financial and operational requirements. The Designated Examining Authority, DEA, is the self-regulatory organization, SRO, most commonly FINRA, that is assigned the primary responsibility for examining a broker-dealer for compliance with financial responsibility rules, operational requirements, and other federal securities laws and SRO rules. This designation streamlines regulatory oversight by having one SRO primarily responsible for a firm's examinations. For example, if a firm is a member of FINRA, FINRA typically serves as its DEA and conducts its financial and operational audits. The DEA ensures that the firm adheres to all applicable regulatory standards.